Why does China build high-speed railways so fast? And why so many? High-speed railways are a point of pride for China. But their greatness isn't just about cutting-edge technology, it's about their sheer scale. Right now, China's high-speed rail network stretches over 40,000 kilometers or about 25,000 miles, making it the undisputed leader worldwide. For comparison, Spain in second place has about 4,000 kilometers, roughly 10 times less than China. Japan in third has just 3,100 kilometers. And the US? It barely has over 100 kilometers or 62 miles of high-speed rail, with most tracks unable to support speeds above 240 kilometers per hour. So why aren't other countries building high-speed trains as quickly or at all? Obviously, China officially claims its massive railway expansion is thanks to the outstanding leadership of the Communist Party and the advantages of its centralized system. Compare that to the US, where building a high-speed rail can take forever due to endless debates and votes. Democracy, they say, leads to gridlock, and nothing gets done. But is that the whole story? What makes China's high-speed rails so impressive is that these railways aren't just about transportation anymore. They've become a tool for manipulating capital. What do I mean by that? First off, China's high-speed rail system is definitely running at a loss. Ticket prices are relatively cheap compared to the massive costs of construction. Yet, despite these losses, trains keep running and new lines keep getting built. But how? Thanks to huge subsidies from the central government. To many, high-speed rails look like a social project, a way for the government to boost mobility and spark economic growth across China. In some countries, social benefits might mean free healthcare. In others, you get free Wi-Fi in McDonald's. While in China, it's affordable transportation. But there is a catch. China State Railway Group has racked up over $834 billion in debt. And it's not just the state company footing the bill. Take the Nanjing-Hangzhou line, for example, built with local governments in Zhejiang and Jiangsu provinces. Since it was one of the early lines, local governments covered 40% of the costs, while the state railway company covered 60%. As high-speed rails became a bigger success, more cities wanted in. Over time, the state company's share of funding shrank. By 2016, for the Zhengzhou-Jinan line, local governments were paying 70%. After 2020, almost all new rail projects were funded entirely by local governments. Everyone knows tickets are cheap and the rail system constantly loses money. So why are local governments so eager to build these stations, even when they don't turn a profit? Many argue it's not just about ticket sales or the railway company's bottom line. It's about the potential value a high-speed rail station brings, like boosting a city's GDP. And that's true, to an extent. Connecting a city to the high-speed rail network can have economic benefits. But does a station really drive GDP growth? If it's built in the right spot, sure, but the impact takes time. From project approval to completion, it can take 5 or 6 years. Then, it might take another 2 or 3 years to see any noticeable GDP boost. That's 7 or 8 years total, way longer than most local officials' terms. Let's be real, even in China, officials aren't so selfless that they are building these stations just for the public good. There is something most people miss. The real secret is that high-speed railways transform cities mainly through rising property prices and land-related financial schemes. Take Sutian, a relatively small city in Jiangsu province. Its high-speed rail station opened in 2019, but it's far from the city center. With the station's arrival, a huge stretch of land between the station and downtown Suqian came alive. Tons of new residential complexes popped up, turning what was once empty land into a hotspot for developers' investments. When developers pour in that kind of money, local governments cash in big. For example, one residential complex near the station could bring the government about $37 million just from land sales, not to mention the value of all the previously worthless land sold off. This is the real reason local governments are so eager to build stations. Without them, those areas would just be farmland. Here is where the capital manipulation kicks in. Local governments borrow money through financial platforms to fund rail construction. Once the station is built, they hype up the idea of a new high-speed rail city to sell the land. They profit twice, once when the project is approved, and again when the station is finished. With all this buzz, the land's value far exceeds the cost of building the railway. Combine that with China's previously booming housing market, and building stations became a no-lose deal for local governments. For officials, a full government treasury means more opportunities to pocket some for themselves, fund further investments, boost GDP, and secure promotions. Unlike other countries, Chinese railways aren't just about transportation. In Japan, the US, or Europe, high-speed trains are built as transport systems, with profits coming mainly from ticket sales. Since land in those countries is privately owned, even if a station boosts nearby property values, the government doesn't see much of that gain. This makes it harder for foreign governments to build high-speed rails on a large scale. They have to weigh construction costs against ticket revenue. If tickets are too pricey, people will fly long distances or drive short ones. If they are too cheap, the project never pays off. But for Chinese local governments, that doesn't matter. They don't care if stations make money from tickets. What matters is whether the station drives up land prices. If land values rise, the investment pays off. So, Chinese high-speed rails and foreign ones are fundamentally different. China's playing a game with land-based capital, while foreign high-speed trains are purely about transportation. That's why other countries can't match China's speed of construction. It also explains another common question. Why are railway stations in China, especially in smaller cities, often built so far from the city center? Sometimes you spend 40 minutes on a train, then even more time getting from the station to downtown. Why not build stations closer to the center, where they are easier to reach? Wouldn't that also raise land and housing prices? Sure, but it's not as effective as carving out a whole new area and hyping a new high-speed rail city to sell previously worthless land at a premium. Early on, this model had a real positive impact. It's why Chinese high-speed rail network expanded so fast. But as the saying goes, what lifts you up can also bring you down. Many of today's problems with Chinese railways stem from this very model. First, because it's all about capital manipulation, it's led to a big issue: blind construction of stations. These stations aren't built to boost the economy, but to sell land. A lot of cities don't consider population size or actual needs, resulting in way too many stations. Take Danzhou for example, a city with a GDP of about $14 billion and a population of around 1 million. It has 3 high-speed rail stations. One of them, Haidou Station, is nearly 100 kilometers from the city center. Its daily passenger traffic is just a few hundred people. peanuts for a city of 1 million. If China had stopped building railways 4 or 5 years ago and focused on densely populated areas like Guangdong-Guanxi, its high-speed rail system would truly be something to brag about. But today's situation? Not so much. China has a clear oversupply of high-speed trains. This is a flaw in the Chinese system itself. Early on, the enthusiasm for building trains was sky-high, and construction moved fast. But this kind of capital manipulation inevitably leads to overbuilding. And the side effects are starting to hit. First, there is a massive debt from high-speed rail projects. As I mentioned, the state railway company has $834 billion in debt, with $21 billion going to interest payments alone each year. While the company's profits improved slightly last year, their financial reports show most of that profit comes from other sources, usually code for government subsidies. And that's just the state company's debt. Many railways were funded by local governments. For example, Yunnan's local government debt is $59 billion. We don't know the total debt of all local governments, but it's massive. In recent years, in some smaller cities, building stations no longer boost housing or land prices. Many places have stations, but no new homes are being built, and land isn't selling. In other words, investing in infrastructure to fuel land-based finance is like gambling. When the housing market was booming, it was a game with a 9 out of 10 chance of winning. But during a market slump, it's a high-risk bet with a 9 out of 10 chance of losing. And as always, the burden of these gambles falls on ordinary people. On top of that, this massive construction has a downside. It suppresses consumer spending. This has become more noticeable lately, with news outlets increasingly talking about insufficient consumption. China's consumption levels are indeed low. Social spending makes up less than 40% of GDP, compared to 70% in the US. Why do Chinese people spend so little? Through one infrastructure project after another, the wealth of ordinary Chinese citizens is constantly siphoned off. Sure, stations, railways, and high-speed trains got built, but at the cost of severely squeezing people's ability to spend. Some might say investing in high-speed trains should be judged by their hidden economic benefits. And that's true, there are benefits, but there are also downsides, like weak consumer spending. When you look at skyscrapers, high-speed trains, highways, and other infrastructure, few countries can rival China. Shanghai might only be matched by Tokyo. Chinese nationalists often claim this proves China has surpassed everyone else, and that the GDP of the US or most European countries is just a mirage. But they miss a key detail. This rapid growth comes at a cost. Other countries may have higher per capita GDP, even if their infrastructure looks less flashy or gets built more slowly. That doesn't make their progress less real. It just means the price of China's shiny facades and fast trains is hidden. In the past, ordinary Chinese people paid for those impressive skyscrapers and trains with low wages, limited social benefits, and unaffordable housing. In the future, the cost will likely be even higher. The government will face massive debts and a slowing economy due to weak consumption. As China's economic growth slows, it's entering a phase of paying the price for its rapid development. But the full consequences won't sink in right away. It might take a decade before many in China realize what these infrastructure achievements really cost. Thanks for watching. If you enjoyed this video, give it a like, drop a comment, and don't forget to subscribe. Thanks again, and see you next time.